Imagine hitting print on a magic money machine. But every 4 years, without fail, its software automatically forces it to print exactly half as much money as before. Sounds wild, right? Like something out of a sci-fi flick designed to make economists sweat. But this isn't fiction. It's a core, unchangeable feature hard-coded into the world's biggest cryptocurrency, Bitcoin. It's called the halving, and it's arguably the single most talked about, debated, and potentially price-moving event in the entire crypto universe. Does it automatically mean number go up? Or is it just hype? Understanding this programmed supply shock is absolutely crucial if you have any skin in the digital game. Okay, super quick Bitcoin refresher. Decentralized digital cash. No government, no central bank. Transactions recorded on a public ledger called the blockchain. New coins are created, or mined, by powerful computers solving complex mathematical puzzles to verify transactions and secure the network. Think of them as digital prospectors digging for digital gold. Now, for their hard work, these miners get rewarded with brand new Bitcoin. Simple enough? Cool. Here's where it gets interesting. The halving. Built into Bitcoin's original code by the mysterious Satoshi Nakamoto, it's a rule that triggers roughly every 4 years. Specifically, every 210,000 blocks added to the blockchain. When this happens, the reward miners receive for discovering a new block gets slashed precisely in half. Kaput. Reduced by 50%. When Bitcoin started back in 2009, miners got a whopping 50 BTC per block. Then came the first halving in November 2012. Boom, down to 25 BTC. July 2016 saw the second halving. Zap, 12.5 BTC. May 2020, the third halving. Slice, 625 BTC. And most recently, in April 2024, the fourth halving kicked in, dropping the reward to just 3.125 BTC per block. This continues until roughly the year 2140, when the final fraction of a Bitcoin is mined, hitting the hard cap of 21 million total coins. Why build this in? Genius or madness? The idea was likely twofold. First, control inflation. Unlike government-backed fiat currencies where central banks can theoretically print infinite money, hello inflation, Bitcoin has a predictable decreasing rate of new supply. It mimics the scarcity and increasing difficulty of mining precious metals like gold, hence the nickname, digital gold. Second, it ensures a finite supply, making Bitcoin inherently deflationary in the long run. Scarcity theoretically boosts value. So the core economic argument is dead simple. Supply and demand 101. The halving drastically reduces the rate at which new Bitcoin enters the market. If demand for Bitcoin stays the same, or keeps growing, as more people adopt it, institutions buy in, etc. But the influx of new supply gets cut in half. What should happen to the price? Basic economics screams up. It's a pre-programmed, predictable supply shock. Sounds like a guaranteed winning formula, right? Well, let's check the tapes. History lesson time. What actually happened after previous halvings? Halving numero uno, November 2012, 50 to 25 BTC. Bitcoin was niche, trading for peanuts, around $12. In the year following the halving, Bitcoin went on an absolutely berserk bull run, rocketing up over 8,000% to peak above $100 in late 2013. Coincidence? Maybe, but a spectacular one. Halving the second, July 2016, 25 to 12.5 BTC. Bitcoin was trading around 650. The market was more developed. More people were aware. Did lightning strike twice? Pretty much. While the immediate reaction was muted, 2017 saw another explosive bull run, with Bitcoin screaming towards $20,000 by December. Again, other factors were at play. Media hype, retail frenzy. But the halving preceded the madness. Halving the third, May 2020, 12.5 to 6.25 BTC. This one happened amidst peak COVID weirdness. Bitcoin was around $8,600. The pattern held, arguably stronger than ever. Starting late 2020 and into 2021, Bitcoin went parabolic, smashing previous highs and eventually reaching nearly 69,000. Institutional money started piling in, adding fuel to the fire. Which brings us to halving number 4, April 2024, 625 to 31125 BTC. The context was different again. Bitcoin had already seen huge price appreciation leading into the halving, partly fueled by the launch of spot Bitcoin ETFs in the US, making it easier for mainstream investors to get exposure. The price was hovering around the 60K, 65K mark. So what happened post-April 2024? As of now, early May 2025, we haven't seen that same immediate face-melting vertical explosion that followed the previous cycles within the first year. There's been volatility, sure, but the historical pattern suggests the major fireworks, if they happen, often ignite several months post-halving and build over the following year or so. The jury is still out on whether this cycle will rhyme with history, or if the game has fundamentally changed. This leads us to the crystal ball gazing, price predictions. After every halving, predictions fly thick and fast. Models like the controversial stock-to-flow ratio, which plots price against scarcity, suggest astronomical figures. You'll hear analysts calling for 100K, 250K, 500K, even $1 million per Bitcoin. Sounds amazing! But here's your reality check. Infographic style. Anyone claiming to know Bitcoin's future price is either delusional or selling something. Past performance is not a guarantee of future results. The Bitcoin market today is vastly different than in 2012 or 2016. We have ETFs, futures markets, increasing regulatory scrutiny, major macroeconomic headwinds, and way more institutional players. The halving is just one powerful factor in a very complex equation. So, how should you think about this as an investor? What are the strategies? First, the priced-in debate. The halving dates are known years in advance. Does the market anticipate the supply shock and factor it into the price before the event happens? Increasingly, maybe. The massive run-up before the 2024 halving could support this theory. The classic trading adage, buy the rumor, sell the news, sometimes plays out, with price potentially peaking around the halving event itself before consolidating. Historically, a common strategy was accumulating Bitcoin in the months before the halving and holding for the 12 to 18 months after, aiming to capture the potential post-halving bull run. This worked like a charm the first 3 times. Will it work the 4th time, 5th time? The diminishing returns argument suggests each halving's impact might lessen as the absolute reduction in new supply becomes smaller relative to the total existing supply and daily trading volume. Don't forget the miners. Halving directly slashes their revenue. Less efficient miners, with higher energy costs, might become unprofitable and shut down. This can temporarily decrease the network's hash rate, computing power, and potentially lead to more mining centralization among bigger players. Something to watch. Ultimately, the halving reinforces Bitcoin's core value proposition, digital scarcity. For long-term believers, it's a fundamental bullish catalyst underpinning the digital gold narrative. Trying to time the exact peaks and troughs around it is notoriously difficult. A less stressful approach for many is dollar cost averaging, DCA. Investing a fixed amount regularly, regardless of price swings, to smooth out volatility and avoid emotional decisions. Crucially, remember rule number 1 of crypto. It's volatile as heck. The halving doesn't magically erase risk. Never invest more than you can comfortably afford to lose. Do your own research. Understand the technology. Diversification is your friend. So, while the halving isn't a crystal ball guaranteeing future prices, it is a fundamental, non-negotiable part of Bitcoin's economic engine. It's a predictable jolt to the supply side that has, historically at least, preceded Bitcoin's most dramatic market cycles. Understanding the mechanics, the history, and the surrounding debates is vital for navigating the hype and making informed decisions. Because this pre-programmed earthquake shaking up Bitcoin's supply schedule happens every 4 years. Whether it guarantees riches is debatable, but understanding the tremors is absolutely essential if you're anywhere near this volatile digital landscape.